Welcome to video 5 from Emoji Trading, looking at order flow and how we bring that to life using the Emoji Trading order flow suite running on Sierra Chart. In our next 3 videos, we're going to evolve our view of the market to identify the underlying supply and demand levels that occur every day, every tick within the market. It's really easy when we're trading to become sidetracked by all of the information available to us: price, volume, derivations of these basic numbers like moving averages and momentum indicators, volume delta, news releases, macroeconomic information, homework levels, and we can end up with way too much information to make a basic decision. Now let's face it, trading is all about basic decisions. Am I going to buy, sell, or do nothing? If I've already bought or sold, am I going to close my position, hold it, add to it, or sell part of it? A good way to hold on to a simple view of trading is to keep phrasing things in terms of supply and demand. In this way, support, or a price level that holds, is demand. Think about this another way. At a given price, irrespective of the level of selling, buyers exist to buy, and price does not need to fall any further in order to attract buying. Conversely, resistance represents supply. However much buying occurs, there is more than enough supply to satisfy this, so price doesn't need to go higher. We can make this way of thinking become second nature by thinking about it in the context of our daily life. It's pretty unlikely that if we go to the supermarket to buy a box of breakfast cereal that there will ever be a lack of supply. So even if we invited all of our friends and family with us to the supermarket to buy cereal, we'll all be satisfied and there'd be no reason for the supermarket to raise prices. We can take this thinking one level further. Imagine I'm shopping and the supermarket's decided to discontinue stocking a particular cereal brand, and they've reduced the price of this brand by 50% while I'm browsing, and that the remaining 5 boxes on the shelf are all they have left. I'm probably going to be inclined, if I like this cereal brand, to put all of these in my shopping basket at this deal, and my demand is supporting this new lower price. If, however, I only purchased one, and the supermarket was desperate to clear the shelf space in order to put something else out, maybe a new brand, they may well need to reduce the price of the remaining 4 boxes further. But when I put all 5 in my basket, my demand at that moment supported the price. If at school or university you've ever taken any economics class, you'll recall that very early on in the course, supply and demand graphs are introduced which illustrate this point really simply. With all things being equal, as price rises, fewer buyers buy, and as price falls, fewer sellers sell. Or, if we have more buyers than sellers, price must rise in order to match supply and demand, or the other way around. If we've got more sellers than buyers, price must fall. In trading, this reducing level of demand or supply is known as exhaustion. When we trade with numbers bars, we can see the supply and demand at every price level, and we can start to make trading decisions that are based upon the supply and demand that we can see. So let's look at how order flow can help us identify exhaustion. We all love to trade a trend. New traders aim to buy at the very start and sell at the very end. But as we know, price doesn't move in straight lines. It auctions backwards and forwards, finding support at different levels as it journeys between point A at the start and point B at the end. Experienced traders will look for pullbacks within the trend for entry opportunities and also monitor the trend for signs that it may end. Exhaustion is just as the name suggests. The buying or selling pressure becomes exhausted. It runs out. And if we don't have buying or selling pressure, it's unlikely that the immediate direction of price will continue. And it's much more likely that price will churn sideways or even retrace until such point as we re-encounter the supply or demand that caused the direction of the price movement. Once again, the basic principles of economics tell us that as price rises, it reaches a point where demand falls, and conversely, as price falls, there will come a point when supply runs out, or in other words, there are no sellers prepared to sell at this low price. We can see these situations very clearly in the bid and ask traded volumes that appear on a numbers bar chart. When price is rising strongly, we see various levels of demand at price levels. Once demand declines though, there is no reason for price to continue to rise. We tend to see these declines in supply and demand at the lower and the upper extremes of price bars. At the bottom of the price bar, representing lower prices, we may well see reducing supply, and at the top of a price bar, representing higher prices, we will tend to see demand tail off. The emoji trading reducing volume indicator highlights situations where rising price results in reduced buying and falling price results in reduced selling. The indicator highlights when volume starts to decline at the extremes of a price bar. If we see price rising but demand is falling, we know that buying power is running out. This is exhaustion. So we can expect in the near term that price may pause or potentially reverse. While this isn't really a reason to open a new trade, this is a good early warning sign if you're already in a position to perhaps tighten stops or take some profits. Likewise, it's a good red flag to not open a position in the direction of the price movement. We can use this indicator with a few different Sierra chart draw styles. The box offset draw style pairs are good for a warning. Alternatively, you can use the fill draw style combinations to highlight the bar extremes. We can go one step further and use the indicator's extend until future intersection option, and the chart will highlight the zones where there is sufficient supply to meet demand, in other words potential resistance, and sufficient demand to meet supply, in other words potential support. At that point, monitoring the behavior of price will determine whether the trend is likely to continue or reverse. We can take this idea of exhaustion one stage further using the Emoji price rejector indicator. This looks for falling supply or demand at extreme price levels in combination with aggressive trading activity in the opposite direction. What we can see here is that price approached the high of the day, we experienced reduced buying volume combined with aggressive selling on the other side of the bar. When we use price rejector, it's important to consider this indicator as an early warning of potential change. A price rejection at a significant level, for example the high of the day, combined with supporting delta is a strong indication. If delta, however, does not support the rejection and the potential price reversal, it's wise to stay alert for indications of reversal such as aggressive price activity, absorption, maybe changes in delta in the next bar, this kind of thing. So as you can see, the extremes of price bars give us some good insight about supply and demand. We can also use the Emoji bar ratio indicator to bring the extremes even further to life. When we apply this indicator to a chart, we can see a summary of the conditions at the extremes of the bar. The indicator calculates ratios of traded volume by looking at the volume that traded on the bid side and the ask side at the bar's extremes. If we have a bar where there was more buying at the top of the bar than the price levels below it, and the bar also closed lower, we can determine that the buying at the top of the bar was being absorbed by a large passive seller. If, however, we have a price bar that closed lower, and there was less buying at the top of the bar than at the price levels below, then just like with the reducing volume indicator, we know that this is a sign of reducing demand, or in other words, buying exhaustion. The same principles apply at the bottom of a price bar. If we have heavy volume at the bottom of a price bar, and certainly heavier than the price levels above it, we're experiencing absorption. If we have decreasing levels of selling at the bottom of a price bar, it's a sign of exhaustion. The inputs for the bar ratio indicator consider the ratios between the two extreme price levels on the bid side and on the ask side. The default ratios are set to levels that can provide a good indication of absorption and exhaustion. And we're not so bothered about the actual ratio that's calculated. What we're more concerned about is whether the bar ratio is below or above these thresholds. We can set the bar ratio indicator to display signals in various ways. With numeric, we'll show the ratio for every price bar. With conditional numeric, we filter out those ratios that don't represent exhaustion or absorption. Conditional text is my personal favourite. I like charts to make it really obvious what's happening in the market. We can apply a text label to each absorption and exhaustion condition, and the chart will actually tell us what's happening. Big buyer, no sellers, this kind of thing. Finally, the compact display mode will simply place a symbol on the chart if we have an absorption or exhaustion condition. This is good if you like to trade using a really clean, uncluttered chart, or if you just want to trade using candlesticks, Heikin Ashi or Renko bricks. The emoji single print at extreme indicator highlights when we have a lack of demand at the top of a bar or a lack of supply at the bottom of a bar. If we see traded volume of under 10 contracts at the bar's extreme, then we can highlight this price level, as we know this price level may well form future resistance or support. And once again, we can extend this price level out until it trades in the future. So now we've started to consider how we bring supply and demand concepts to life using the Emoji Trading Order Flow suite. And we've started this by considering exhaustion, or what happens when we run out of buyers or sellers. In our next video, we'll examine how to highlight other signs of supply and demand. See you then.